Markets nursing a bit of a Fed hangover with the Dow dropping nearly 300 points in the last 2 days since Fed Chair Powell spooked stocks with one word, transient. Bob Pisani's at the NYSE to break it down. Bob.
It's not just Powell. So we've had a few headwinds battering the market over the last couple of days. So you saw crude oil today. It sold off. It was 65, ends at around 61. And you can see the S&P moved almost in tandem with oil today. That doesn't happen that often, but there's bigger issues out there. We have moved 40 points in the S&P in the prior 8 days or so to new record highs on Tuesday or so. So a lot has to go right for the markets to keep going up like this. Stocks are hitting resistance, and you know what? It's about time. Stocks are pricey. Forward earnings multiples over 17 now. That's well over the historic norm of 15 to 16. The markets essentially now want to try to shift the discussion on several important issues. Number one is the Fed and central banks. You mentioned that, Melissa. Fed Chair Jay Powell's dashed hopes for any kind of rate cut now. And this patience mantra, it's wearing thin with the markets. Only China is in an aggressive stimulus mode, the central bank there, I mean. Markets want other central banks to get back in to the stimulus mode, including the Fed. Then there's trade talks. Even vague rumors today that there was not sufficient progress caused a little bit of a midday trading blip. And for the last month, the markets have risen because global growth sentiment has improved. We keep saying there's a belief China and Europe is bottoming. But now we need more than just sentiment. We need to see a few months of hard economic data to show those recoveries over there are actually real. Finally, no earnings recession. That may not be enough with stocks this pricey. We've avoided an earnings recession. That's great. But we now have likely several quarters of flat earnings. That may not cut it either. We need low single-digit gains in the second and the third quarter, high single-digit gains in the fourth quarter. Melissa, earnings growth for 2020, it's already about 12%. So you see what I mean? The market's expecting a lot to go right to get things moving again. Back to you.
All right, Bob, thank you. Bob Pisani at the NYSE. It may be more than a hangover hitting the market. Our next guest thinks the global growth scare is coming, and investors are too optimistic at record highs. Let's bring in Michael Kantrowitz from Cornerstone Macro for his Fast Money debut. Welcome to you, Michael.
Hi,
and you work with Carter,
absolutely,
who's on here, who's quite bearish. You just sit around and toss around bearish scenarios.
Bear club, just make everyone want to push us out of the room.
So what are you looking at right now? Because I mean, I thought that the China data was coming in a little bit better. Europe was showing some signs of stabilization. What is the global growth scare that's coming, in your view?
Well, we're concerned that we've had a Fed tightening cycle, and it's the first one since 2006. So we haven't had a tightening cycle post-08. And so a lot of things have changed around the world post-08 that have ended up differently in how we expected. When you look back at the last 12 Fed tightening cycles since 1950, all of the bad news in the market and the economy happens after that last rate hike. So the market has gone up in the last 4 months because the Fed has backed off. If you go back the last 12 cycles, that is exactly what happens. PEs go up, bond yields go down, and investors are really excited the Fed's done, and maybe they cut. However, what we have seen in every cycle after the Fed has cut rates is things like the ISM index, which is a great proxy of earnings growth, ahead goes below 50 into contraction territory. And yesterday's data point, one of the lowest readings in a couple of years, I think is continuing to follow the path of what happens after a Fed tightening cycle.
So how do you translate this into what the markets will do for the rest of this year and next year?
Sure. So we've gone up because this excitement around the Fed going away. And it's all been, as Bob mentioned, all PE expansion. And the number of companies now saying we're going to see a second half earnings growth, a pickup, and that's what investors are banking on, and that China's been doing all the stimulus and expecting China to lift the world as it has done a couple times in the last 10 years. We don't believe that's going to happen, and we're seeing a lack of monetary easing in China. They've done a lot of fiscal reform, tax cuts. That is going to lead to a different recovery than we've seen in the past. And I think you're seeing that in metals and mining stocks. Copper prices have been flat for a few months now. Cyclical stocks have been very volatile. And so I think we're seeing just a lack of earnings expectations really improve from here. And I think that's going to continue, and that's ultimately going to catch up to the equity market.
Do you think, though, that this recent move, Michael, it literally just seems like from a sentiment standpoint more towards an easing rather than to another hike? Obviously, the last hike that you're talking about came in December. When we were at some point in Q3 or Q4 of 2018, we were expecting 2 to 3 hikes this year. The talk of a cut, what does that do to these expectations so contracted in this cycle, this rate increase?
Well, I think I think we will get a cut. If our stories plays out and we do see that PMI go below 50 and the global PMI, which came out today, which has fallen for 12 consecutive months now, that's never happened in the history of the data going back about 30 years. I think the Fed ultimately will cut rates. And when you look at what drives the Fed to cut rates often, it's not inflation coming down, it's growth slowing. It's things like unemployment claims rising or PMIs going below 50 and ultimately the market having a pretty nasty correction. You look at rate cuts historically, they happen when core inflation is still pretty elevated. And so I think it's going to take a lot to get the Fed to cut rates here, and investors expecting that to happen and banking on that to happen while things remain healthy, I think are going to be disappointed.
Do you have a target for year end?
I think we're going to, as we get to the back half of the year and investors that expect PMIs to recover and earnings expectations to recover, that falls short. I think the market can fall 10 to 15%. Easily from here with cyclical seeing more downside. Our favorite market is still the S&P and actually still the NASDAQ because it's got the least cyclical exposure around any other market around the world.
So a drop of 10 to 15% is actually better than what we'll see in some other markets?
Yeah, I'd say that's for the S&P.
Right.
For more cyclical emerging markets, for Europe, for small caps that have a lot more financials, industrials, energy, materials, globally economically sensitive groups. While they're low PE doesn't always mean low risk.
Sure. And Michael, thank you so much. Michael Kantrowitz of Cornerstone Macro.
Well, it's hard to argue with the discussion of ISMs and where the Fed has typically pushed the market essentially to a place that with that last hike a little bit too far, which is maybe where we got. My view is that the things I would be watching in the short term, because, it's one thing to talk about an Intel or a Google, be long-term stocks and talk about the fundamentals there. When I talk about markets, I try to think of the setups, and I don't think I can tell you out past 3 months where the market's going to go, rather than tell you, I think the dollar is something to watch, and I think the Fed is something to watch. If the Fed actually starts to tell you that they are not as dovish as you think, even though everything Michael just said, and I'm not goodbying the guest and bringing him back, is something that ultimately could have you, effectively seeing markets start to get, somewhat ebullient. I think in the short term, markets do nothing.
I think the market, we've talked about this, how much power or ammo the Fed needs if we enter into another recession. We've talked about whether it's 5%, whether it's 3%. They just don't have enough ammunition. They have the balance sheet they could play around with, but I think that would send a surrender sign to the overall markets that now they're going back to the balance sheet. So I think ultimately this is a sell-off. Unfortunately, a lot of people who have been calling for a sell-off have been wrong on the timing. So eventually that 10 or 15 is coming. It's just a matter of it's very long in the tooth. We've been holding our breath for it.